To, of course, for chatting with you again soon. Right now, we're looking at a market which is down 75 odd points. It's not too bad. It's holding and it's actually above the immediate opening lows. Look at L&T. Let's pull up the intraday chart of L&T. There's a big move on that stock, which is helping the bulls' cause. There's Reliance, there's L&T, and Lever and ITC. Like I said, these are the four big pillars which are trying to fight from the other end. And L&T is having a good morning so far. Reliance, obviously, is fairly steady. But for the time being, let's move on and put the spotlight on vehicle financiers. Is there a slowdown in the making and is there a risk to AUM growth as competition heats up in the space? Well, let's talk about this with the two experts. We have with us Krishnan Sitharaman, Senior Director and Chief Ratings Officer at CRISIL Ratings, and also M Karthik, Senior Vice President and Co-Group Head Financial Sector Ratings at ICRA. Gentlemen, thank you very much for joining in. Krishnan, I want to open with you because we were going through that note that your team put out suggesting that there is intense competition and banks are really out to, get a bigger share of the pie. And therefore, maybe NBFCs, which are in vehicle financing, maybe they could see a pressure on growth. Just expand on this. How serious do you think this competitive intensity could be? And what are the growth numbers that you're working with for this year and maybe next year if you have FY26 numbers as well?
Sure. So thank you so much for having me on the call. Good morning to everyone. So yes, we are looking at a slight slowdown in the AUM growth, the assets under management growth for the vehicle finance NBFCs. We must keep in mind in this context the last 2 years, the industry was coming out of the pandemic and there was I would say a pent-up demand, which was kind of helping the growth, including the vehicle sales were also looking up. So last fiscal, the vehicle finance NBFCs had an AUM growth of around 21 odd %. We expect that to come down to 15 to 16% in this year and next. And largely on account of the fact that the economic growth is expected to be lower. Last year we had a GDP growth of 8.2%. This year we are expecting 6.4%, next year 6.7%. The industry itself is on a cyclical pattern. And so the sales growth will be muted. At the same time, what will support the growth is the fact that the NBFCs are focusing more on the used vehicle segment, which is looking up, and as well as the fact that the ticket sizes are going up, which points towards premiumization across the various segments. Within the segments, we expect the CV financing to grow at around 11 to 12%, but the car and the UV segment, which is around the 1/4 of the total mix, that is expected to grow at around 22 to 23% because we are seeing increasing proportion of UVs, utility vehicles in the mix. In the increasing sales, 65% are utility vehicles, which is around double the number that we had seen around 4 to 5 years back. So while the economic growth trajectory and the unit sales would actually put pressure on the growth, that said, a focus on used vehicles as well as increasing premiumization would help to support the growth trajectory. All in all, we expect 15 to 16% AUM growth this fiscal and next in the vehicle financing NBFC space.
Okay, which is maybe not bad, but obviously compared to 21-22%, it is a slowdown, which we have to take note of. Let me ask Karthik as well. Karthik, morning, good to have you in this discussion. Do you broadly concur? And apart from the base, what are the other reasons that could be responsible for the slowdown?
Yeah, good morning. Base is a key factor. Of course, our numbers are very close to what Krishnan said. So we are looking at about 16-17% kind of growth this year and maybe around 14-15% growth for the next financial year. So base is playing a key role. This apart, of course, the vehicle sales and the general economic activity. These are the key drivers that go into the vehicle financial AUM growth. Funding is something that we are closely looking at. Banks are the key funders to the NBFC space. Bank credit growth slowing could also pull into the slowing growth for the NBFCs. Most of the NBFCs in the vehicle finance and space are the traditional, the conventional old NBFCs, and most of them are large players in this space. So funding constraint could be relatively less impacted for them. The smaller ones are the ones who will get more impacted. We are seeing some headwinds on the asset quality part. Of course, this again comes from a very, very pristine year that we went by. March 24 was possibly one of the lowest in terms of reported asset quality numbers. We are seeing some uptick. We have seen a 20 basis point increase between March and September. We expect this number to go up to 30 to 50 basis points in the next 2 to 3 quarters. So there are some headwinds on asset quality, but these numbers again are much lower than the long-term averages that the sector is seeing. But largely the growth will be slower than last year on account of higher base, lesser sales volume, and general economic activity being slower than what it was previous year.
Okay. Krishnan, so let's talk about some of the the segments that you briefly alluded to earlier. So it seems that SUVs and the premiumization, that's keeping the growth trajectory intact, right? On the CV side particularly, and CV is maybe not so much of old vehicle financing, but in general there's been hardly any CV pickup. Maybe some green shoots, we're still holding on to hope. How does that feed into the overall analysis and the numbers? Are you expecting any improvement there?
So, as I said, we expect on the CV financing side growth to be in the trajectory of around 11 to 12%, and that would be lower than what we saw last fiscal, again on account of the fact that the CV sales are more closely linked to the economic growth trajectory, and that coming down would mean that there would be some challenge there. If I look at CV sales growth, unit sales growth, we are expecting to be relatively flat this fiscal vis-a-vis last fiscal. We had a decent growth there. And when I look at that, if I look at it in that context, the CV financing AUM would actually outperform the sales growth, because here also the context of premiumization will play a role, and higher ticket size vehicles are getting sold today, larger tonnage vehicles, and used vehicle demand is also higher. So when we look at the growth in new vehicle AUM and used vehicle AUM, the used vehicle AUM over the last 5 years has been double that of the new vehicle AUM growth. And in our analysis, the proportion of used vehicle AUM in that NBFC AUM mix has gone up from around 41% to 49%. So it is almost half the AUM now in the last 5 years. That's the growth trajectory. Almost half the AUM now is contributed by the used vehicle space. So used vehicle, we are seeing trajectory, and a part of that story is linked to the fact that the rural India recovery is happening. More of the used vehicle sales happen in the non-urban areas, and given the fact that the monsoons have been better and the Kharif crop has been decent this time around, so we are seeing increasing the cash flow trajectory of rural buyers as compared to the last 2 fiscals where there were some challenges there. Urban's slightly more muted this time, but the rural growth trajectory, recovery trajectory is helping the used vehicle side. So we do expect the used vehicle to support the CV financing growth. Got it.
Gentlemen, very quickly, I want to move to expectations on profitability and margins as well. Now, assuming that we'll be in some sort of a rate cut cycle for the rest of this year, and the point on the competitive intensity, because banks want to get into this business as well, just give us an outlook on what you're expecting on margins, cost of funds, and broadly how spreads are going to move, whether it's banks in this area of vehicle financing or of course the NBFCs as well. Karthik, what are your estimates?
NBFCs have a flexibility to change their business mix. They can get into the used vehicle a bit more to maintain the margins. So that flexibility the NBFCs do have, and they have a larger play. And as Krishnan said, the used vehicle business is growing slightly faster than the new vehicle business, because the used vehicle business or the market itself is quite substantial in relation to the new vehicle sales. So if one were to look at the CV business, you have about 2 to 3x of volumes which is happening at the used vehicle side. Some of it, on the formal part, the other being informal part. Even the formal part is good enough to support the used vehicle growth. Similarly, on the cars, the used car market is about 1.5x plus of what we see in the new. So NBFC
margin, a little short on time. Sorry, I'm pressing you, but margin expectations for vehicle financiers this year.
We could see margin to be largely stable because of the product mix change, moving towards the high yield used vehicle segment. This would result in some contribution of credit cost going up, but on a net basis, I think it will be a margin neutral kind of a proposition for them.
Krishnan, margins this year?
Yeah. 10 to 20 bips for fall in the margins. FY24 return on managed assets was 2.3% for the vehicle financiers. It should land up at 2.1 to 2.2%, largely due to the credit cost increase, but that will still be higher than the 1.5 to 1.7% that we saw from FY20 to 22. Last 2 years we saw pickup because of the growth in the AUM.
Okay, all right. We'll watch this space. Thank you very much for giving us some key trends that will probably define how NBFCs fight for their share in the vehicle financing market. Thank you very much for joining in. Back to the markets.
Just one point. The problem for the markets